The Fed is cutting rates. Powell will talk, and the algorithms, well, they will trade. But that's just the warm-up act. The real story hits after the bell when Microsoft, Alphabet, and Meta open their books and tell us if AI is still minting cash or starting to crack. If cloud spend, ad dollars, and capex don't line up, this market finds out real fast who's funding the future and who is just lighting cash on fire. The Fed's FOMC members have been binging on government coffee and sticky pastries as they go through the motions on voting on rate policy. And please, don't let the pageantry fool you. A steady stream of economists has marched through the Eccles building, that's Fed headquarters, dragging in slide decks so thick that they could probably be used as riot shields. Each one has claimed to found some unique view of this super weird economy. The sales pitch is always the same. The economy is still dealing with sticky post-pandemic inflation, an unprecedented wave of tariffs, a rising tide of layoffs, geopolitical risk, and government shutdown that has starved us of normal data. Labor market distortions also from migration and just general macro madness. And every one of these folks shows up with a fancy curve, a derivative of a derivative, where they solve for the perfect interest rate like they just cracked the Da Vinci Code. Well, here's the reality. They could have just saved the travel budget, met in the lobby, done a quick straw poll, cut or not, and been done in 5 minutes. Because you know why? Because cut wins. Any Fed governor or regional Fed president who says no cut right now is basically saying that they're cool watching the labor market bleed out on live TV, and no one wants to own that dumpster fire. So yes, they'll still hold the vote today. They'll still put on the show. They'll still pretend that this is a brutal, soul-searching decision. And after the vote, they will carefully craft their policy statement to make it sound like they're reluctantly cutting rates, even though inflation is still a problem because they are data dependent and vigilant. That word reluctantly is doing a lot of work these days. But the headline for the market is simple. The Fed is now in cutting mode. Rate cuts are not a one-off. They are a regime at this point. The real fun, though, starts when Chairman Jerome Powell steps up to the microphone after the decision. Powell will talk. The algos, well, they're going to trade. And markets will whip around every word like they're listening for some kind of kidnapper ransom call. We'll all be listening, but let's be honest. The machines, they're going to get there first. And by the time the closing bell hits, we'll have our answer. The Fed is easing, and the market kind of knows it. But guess what? That is not even the main event for tonight, because the second the bell rings, we go straight into a loaded hour of earnings from the only 3 companies that can still move the entire stock market with a sentence. Meta, Microsoft, Alphabet. Sure, all of the Magnificent Seven are in the AI story, but these 3 are standing at the tip of the spear. And if you've been doom scrolling AI bubble about to pop takes, well, this is where you find out if that's just content farm panic or if there's actual cracks in the cash machine. Let's do this right. First, I want you to visualize the money chart. I took Microsoft, Meta, and Alphabet, and I plotted earnings per share, that's EPS, over the past 3 years on my Bloomberg terminal. White line, Microsoft. Red line, Meta. Blue line, Alphabet. Check it out. EPS is exactly what it sounds like. How much profit per share? For mega cap tech, EPS is the scoreboard. You don't get $1 trillion market cap just for having a cool demo video with AI robot voices. You get it because the line goes up and to the right over time. I want you to ignore the exact dollar numbers on the side. Just look at the slope. How steep is the line? How smooth is the line? Does it keep climbing or does it stall? Then look at the dotted extension at the right edge of those lines. Those dotted points are expectations this quarter plus the next 2. That dotted section is where stocks either rip or get taken to the parking lot after hours. Over the last year, since about Q3 of 2024, the street's still looking for double-digit EPS growth out of all 3. We're talking roughly 10% year over year for Microsoft, mid-30s for Alphabet, and close to 40% for Meta. At this size, that's actually pretty insane. So job 1 for tonight is very simple. Do they hit those growth rates or do they wobble? If you miss at the EPS level, I don't really care how beautifully you talk about AI, productivity, monetization opportunities, or transformational journeys. The stock is probably bleeding. If you beat on EPS, cool. Wall Street fires the confetti cannons for about 30 seconds. And then immediately everyone goes under the hood and starts asking whether that EPS beat was real or just a one-time accounting noise. That's why we are about to go name by name. This is how people who actually run money think about these calls. Let's start with Microsoft. For Microsoft, I'm tracking three things: intelligent cloud revenue, operating margin, and capital expenditures. Microsoft is now the purest public play AI infrastructure as a service. They are selling the stack, the compute, the Copilot layer, and the enterprise distribution. Intelligent cloud is the heart. This is Azure plus the rest of their big enterprise cloud business. So metric number one is intelligent cloud revenue growth. If that red line is accelerating, check it out. It tells you that CIOs are still spending, that Azure is winning workloads, and that AI workloads aren't just marketing noise. They're being stood up in live production environments. If that growth line bends lower, that's a tell. It could mean spending fatigue. It could mean pricing pressure. It could mean Amazon or Google just stiff-armed them on a few big contracts. But it means this is not infinite. Second Microsoft metric, operating margin. Why margin? Well, because Microsoft is lighting money on fire to build AI capacity, and investors are still demanding that the company looks like a profit monster while they do it. If Microsoft can hold margins or even expand margins while still pouring capital into AI, Wall Street says, cool, keep spending. We love this. If margins start to compress hard, well, the story flips from AI as a license to print money to, wait, are we entering the low return phase of the cycle? Third Microsoft metric, capex. Capex is just how many billions they're shoveling into data centers, GPUs, network power, basically everything needed to fund this AI thing. Here's the key interpretation. High capex is not automatically bad anymore. If you see high cloud growth, strong margin, and high capex, the message is demand is insane, we're building to fulfill it, and we're already monetizing. If we see high capex, weak cloud growth, and margin squeeze, the message is we're building in hopes that demand shows up later. Not so good. Translation, the first version is genius capital allocation. The second version is we are praying. Okay, on to Alphabet. With Alphabet, the chart focuses on search and other revenue, YouTube ad revenue, Google Cloud revenue, and traffic acquisition costs, and we can't forget capex. Check out the chart. Alphabet is really two companies living in one same house. Company one is the ads machine, search plus YouTube, which actually mints cash. Company two is cloud plus AI plus everything else, which is supposed to be the future. First, Alphabet metric. Search plus YouTube ad revenue. This is still the oxygen tank. You'll hear about AI overviews, Gemini, assistants, whatever. Great. But if search and YouTube ad growth slows, that stock is getting slammed because that cash pays for everything else. Also, ad growth is a macro signal. Advertisers cut spend when they think the consumer is getting a little tired. So if YouTube or core search softens, that's your first quiet warning signal on consumer health. Light bulb. Second Alphabet metric, Google Cloud. Google Cloud used to be, we're growing fast, but we're losing money. Recently, the narrative has been, we're growing and we're profitable. Tonight, you want to see if both of those still hold. Is cloud still growing fast? And is it still making money at a respectable margin? If those two lights are green, well, that's how Alphabet earns a higher multiple because it proves that they're not just an ads company anymore. If cloud growth slips or margins roll backward, the market is going to start asking whether AI workloads are secretly migrating to Microsoft, the competition, instead. Third Alphabet metric, TAC. That's traffic acquisition costs. TAC is what Google pays to make sure its search box is the default everywhere you look. iPhones, browsers, platforms, everything, you know what I'm talking about. If TAC goes up, but ad revenue doesn't accelerate with it, margins get crushed. If TAC stays stable or even drops a little while ad revenue surges, well, that's dream mode. And just like Microsoft, watch capex. Alphabet has to spend to compete in AI, to build out data centers, to run bigger models, to keep up in the arms race. If capex is surging, they need to tell a straight-faced story about how that spend turns into monetizable, product, not just we're building a science fair project. Now let's talk Meta. Everybody still hears Meta and thinks Facebook.com and an annoying uncle sharing weird memes. Cute, but really obsolete. You see, Meta is a cross-platform advertising supercomputer with a global user graph and a growing AI hardware and software footprint. The Meta chart tracks three things: advertising revenue, daily active users, and capex. First Meta metric, ad revenue. Meta is still the most precise targeted ad platform on earth. Full stop. When ad revenue keeps climbing, that tells you that businesses are spending to chase consumers, especially small and mid-sized businesses. If Meta's ad revenue rolls over, that's not just Meta's problem. That is a consumer demand problem, warning us for maybe the entire S&P 500. Second Meta metric, engagement. Daily active users. Meta sometimes calls this family daily active people, which is basically how many unique humans we touch across Facebook, Instagram, WhatsApp, Messenger. This is the gasoline. If users plateau or worse, decline, they have to work harder and spend more to squeeze the same dollars out of a maturing audience. If users keep growing and those users keep scrolling, well, Meta can keep turning the monetization knob higher without blowing up the experience. Third Meta metric, capex. Meta's capex is doing double duty. Duty one, AI infrastructure, recommendation engines, content ranking, personalization, ad targeting, safety, generative ad creation. This kind of stuff prints money if it works. Duty two, long game hardware, mixed reality, metaverse headsets, all the stuff Wall Street, including me, loves to mock until it suddenly works and turns into a platform tax. The curve on Meta capex looks like a spike into late 2025, then it looks like it softens. Investors are going to interrogate that shape tonight, big time. Are we past peak spend, which is bullish? Heavy lift is mostly built, now we harvest returns? Or are we just catching our breath before the next massive leg up in spending, which is bearish if there isn't a clear revenue attached? So let me tie this together for you in one breath. I'm breathing, believe me. Microsoft is the AI infrastructure and software monetization trade. The bet is that AI is not just hype. It's paid consumption on Azure with fat margins. Alphabet is the ads plus cloud transition trade. The bet is that they can protect the golden goose, search and YouTube, while proving Google Cloud is a real profit engine, not just a science project, even as they spend billions building AI capacity. Meta is the engagement plus yield trade. The bet is that Instagram, WhatsApp, Reels, all of it are still attention vacuums, and Meta can keep turning attention into dollars per user, even while it lights mountains of cash on AI and future platforms. And here's your wake-up call. None of this is even exhaustive. We're not even touching buybacks, headcount, regulatory threats, political heat, antitrust, AI safety costs. Oh, or the fact that governments around the world are eyeing these companies like walking tax bases with a pulse. But if you just watch the core levers that I just laid out, Microsoft's intelligent cloud versus margin versus capex, Alphabet's ads versus cloud versus TAC, and Meta's ads versus engagement versus capex, well, you'll understand 80% of the market's reaction tonight. You will know whether the AI build-out is still funding itself. You're going to also know whether the consumer is still spending. You will finally also know whether these companies are buying the future or mortgaging it. So grab a relaxing tea and some cookies for Powell's presser, but be in your chair for the tech earnings, because that, my friends, is where the real ride starts. So your truth bomb for today is this: the Fed can cut rates all it wants, but tonight, Microsoft, Alphabet, and Meta tell us whether AI is still paying for itself or whether the bill just showed up. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out.